Okay, let's unpack this. We're looking into a really interesting piece of business transactions today. Specifically, how deals get done, especially for those small to mid-sized companies you hear so much about.
That's right. We're focusing on seller financing in acquisitions. Think of it like the person selling the business actually helps fund the deal themselves.
Exactly. We've been digging through quite a few articles and notes you sent over, trying to pull out the really key stuff, the strategic bits, maybe some surprising facts about this whole approach.
Yeah, the idea is to give you a solid grasp of what seller financing actually is, why it seems to be popping up more, and, what it means for everyone sitting at the deal table. It's definitely getting more attention.
So let's jump right in then. This term, seller financing. What's the basic idea behind it?
Well, the core concept is pretty straightforward, actually. Instead of the buyer getting, say, all the money from a bank or an SBA loan, the seller agrees to finance part of that purchase price themselves.
Okay. So it's not always the only funding source. It kind of sits alongside other money.
Precisely. Often it works hand in hand with a bank loan, or maybe the buyer's own cash down payment. It sort of fills a gap in the funding stack. In smaller deals, it might even be a pretty big chunk of the total financing.
And how does this actually get formalized? I mean, it's not just a handshake, right?
Oh, definitely not.
Yeah.
It's a proper agreement. The buyer usually puts down some cash at closing. That's the down payment. Then the rest of the price, or at least the part the seller's financing, gets paid back to the seller over time, with interest, of course.
Okay,
Mhm.
okay. So the seller essentially steps into the role of a lender for that slice of the price.
That's a great way to put it. And the sources we looked at consistently point out it's super common in those small to mid-sized business sales. That market often has its own challenges with traditional financing, so flexibility becomes really key.
Right, flexibility. You mentioned that's a big plus.
It really is. I mean, unlike the sometimes very rigid terms you get from big banks, the details here, the interest rate, the repayment schedule, they're all negotiated directly between the buyer and the seller.
So they can shape it to fit the business.
Exactly. Tailor it to the specific cash flow of that business or maybe the buyer's particular situation.
And the formal document for all this, what's that usually called?
Typically, it's referred to as a seller note. It's a formal promissory note, legally binding.
Gotcha. And what key details would you find in that seller note?
It lays out all the essentials of that loan piece. You've got the principal amount, that's the exact chunk of the price the seller's financing. Then the interest rate. The sources mention this can be fixed or maybe variable, and it reflects things like current market rates, the buyer's perceived risk, the business itself.
Okay, principal and interest, standard loan stuff. What else is crucial in that note?
The payment schedule is vital. Like, is the buyer paying monthly, quarterly, how often? Then there's the term length. How many years does the buyer have to pay it all back? Collateral is usually specified too.
What kind of collateral?
Often the business assets themselves are pledged to secure the seller's loan. And this is important if there's another lender involved, say a bank providing the main loan.
Yeah. The seller note will almost always have what's called a subordination clause. Basically, it means the bank gets paid back first if things go wrong.
Ah, okay. So the bank's in first position, the seller's behind them in the queue.
Generally, yes, if it's subordinated. The main point here, though, is that every part of this, the rate, the schedule, the collateral, even that subordination piece, it's all up for negotiation between the buyer and seller. It's very much a bespoke agreement, not off the shelf.
Now, there was a statistic in the source materials that really hammered home why this is so important to understand right now.
Yes, and it's quite a striking number. Something like 60% of small business acquisitions involve some kind of seller financing.
60%. Wow.
Right?
Well, that's most of them, isn't it? It's clearly not some niche tactic.
Not at all.
So what role is it playing that makes it so common? Primarily, it's about bridging funding gaps. Sometimes a traditional lender just won't provide the full amount needed, or maybe their terms are just too restrictive for that particular deal. Seller financing steps in to make up the difference, basically making deals happen that might otherwise fall apart.
And sends a message, too, doesn't it?
It sends a very strong message, yes. When a seller is willing to keep some of their own money tied up in the business post-sale, it really signals their confidence.
Confidence in what, specifically?
Confidence in the business's ability to keep performing well under the new owner. They wouldn't leave their capital at risk if they didn't believe the business could generate enough cash for the buyer to actually make those loan payments over time.
That's a really good point. It's like the seller is vouching for the business and the buyer's ability to run it. Yeah. Okay, let's flip this around. If I'm someone looking to buy a business, What are the big advantages the sources highlight?
For a buyer, yeah, there are several really appealing points. One is that qualification can often be easier compared to getting a traditional bank loan.
Easier than dealing with a bank. How so?
Well, think about it. The seller knows this business inside and out, its operations, its history, its real cash flow, not just what shows up on standardized forms, so they can evaluate a buyer on more than just credit scores.
Like, they might see potential a bank would miss.
Exactly. Maybe the buyer has amazing industry experience, but less personal collateral than a bank wants. The seller understands the nuances of the context in a way an underwriter miles away just can't.
And that flexibility we talked about, how does that play out directly for the buyer?
It means they can often negotiate much more favorable terms. Things like the interest rate, the repayment schedule, maybe even certain loan conditions or covenants, they can all be tailored. You can structure it around the business's expected cash flow cycles or the buyer's plans. Try getting that level of customization from a big bank.
Right, not likely. Faster deal completion was another point, right?
Absolutely. Getting bank or SBA loan approval can take, well, it can take a long time. Lots of paperwork, underwriting, committees, seller financing can cut through a lot of that.
Because the seller already knows the business.
Precisely. Their due diligence on the financing piece is often much quicker, much more focused. Direct negotiation speeds the whole process up.
So you're not stuck in limbo waiting months for an approval that might not even come.
That's the idea. The pace is more controlled by the buyer and seller themselves.
What about accessing different kinds of opportunities? How does seller financing help there?
Oh, this is a big one. It can open doors to businesses that are just really hard to finance traditionally. Think about service businesses, right? Or companies in very specific niche markets.
Why are they harder to finance?
Often because they don't have a lot of hard assets. Buildings, heavy equipment, the stuff banks love as collateral. Seller financing makes these potentially great businesses actually attainable for buyers who might otherwise get shut out by conventional lenders.
So it really broadens the playing field for buyers.
Yeah.
And preserving cash after the deal closes.
Yeah, that's huge. If the seller finances part of the price, the buyer obviously needs less cash up front for the down payment. That means they keep more of their own money available.
For what? Like running the business day to day.
Exactly. For working capital, maybe for making some immediate improvements they plan, or just having a cushion in case things get tight. It just provides a much stronger financial footing right from the start.
Okay, so for the buyer, easier entry, terms that fit, faster deals, more types of businesses available, keeping more cash on hand, and that big confidence signal from the seller, those are pretty compelling.
Definitely.
But let's look at the seller now. Why would they do this? Why not just insist on all cash or make the buyer get full bank financing? What's the upside for the seller?
That's the other side of the coin, and the sources lay out some clear benefits for the seller, too. First off, offering seller financing can significantly widen the pool of potential buyers.
Widen the pool.
It just makes the business accessible to more people. Think about skilled managers or industry experts who know how to run the business but maybe don't have millions in the bank or can't qualify for 100% third-party funding. Seller financing removes that barrier.
So more potential buyers means?
More interest, potentially more competition, and maybe, just maybe, a better overall price. The sources suggest buyers are sometimes willing to pay a bit more in total if they get helpful financing terms from the seller. The seller is essentially getting compensated for taking on that financing role.
That makes sense. Trading better terms for potentially a higher headline price. What about taxes? That's always a big factor when selling.
Taxes are definitely a consideration. When you structure the sale with a seller note, the seller gets paid over several years, not all at once. This can often qualify as an installment sale for tax purposes.
And the advantage of that is?
Instead of getting one huge lump sum in a single tax year, which could bump you into a much higher tax bracket, the seller reports the gain bit by bit, year by year, as they receive the principal payments.
Spreading the tax liability out.
Exactly. It can potentially lower the total amount of tax paid over the life of the note. Now, obviously, as the source stress, anyone considering this needs to talk to their tax advisor. This is crucial.
Absolutely. Good advice.
Yeah.
Okay, besides getting the principal back over time, is there any other financial gain for the seller?
Oh, yes. They earn interest on the outstanding loan balance. That interest income is an extra return on the money they've effectively left invested in the business. It adds to the total proceeds they get from the sale, above and beyond the agreed price.
But they're getting a yield on that capital. like an investor.
In a way, yes. And this ongoing financial stake often leads to something else really valuable, a much smoother transition for the buyer.
Smoother transition. How does having skin in the game change that?
Well, because the seller getting fully paid depends on the business continuing to do well, they have a really strong incentive to help the new owner succeed.
Ah, right. They want their loan repaid.
Precisely. So they might be more willing to stick around longer, offer more detailed training, make introductions, provide guidance, more so than if they just took the cash and walked away completely. They're motivated to protect their investment by ensuring the buyer thrives.
That creates a really powerful alignment, doesn't it?
It fundamentally aligns their interests. The seller needs the business to perform well to get their money back. The buyer needs the business to perform well to make the payments and build their own equity. This shared goal really encourages cooperation and keeps the seller engaged after closing day.
It feels like seller financing is more than just a funding mechanism then. It sort of shapes the whole relationship in the post-deal phase.
I think that's a really key insight from the materials, yeah. It often leads to a much more collaborative way of structuring the whole transaction.
Collaborative? How so?
Well, instead of the buyer just going to a bank and taking whatever standard loan product is offered, here the buyer and seller actually sit down together and craft the terms of that seller note.
Tailoring it specifically.
Exactly. They can shape the payment schedule, the interest rate, maybe other conditions. So it really fits the cash flow profile of this particular business and the situation of this particular buyer. It's about finding a custom fit, not a one-size-fits-all solution.
Moves away from the cookie-cutter approach.
Right. And doing that naturally keeps both parties focused on the long-term health of the business. They both have a stake in its success long after the papers are signed. The seller needs cash flow for repayment, the buyer needs it for payments and growth.
The sources also mentioned it's useful for getting past a common hurdle, disagreements over value, bridging valuation gaps.
Yes, this is a really neat application. It's incredibly common for buyers and sellers to have different ideas about what a business is worth. Seller financing can help bridge that gap, especially if there's some uncertainty about future performance.
How does financing help bridge a value gap?
By financing part of the price, the seller is, in effect, sharing some of the risk related to that future uncertainty. If the buyer's worried the business won't hit projections, having the seller finance a piece means the seller also bears some consequence if things fall short.
Okay, I see.
And the sources noted that while they're different things, sometimes seller notes are used alongside mechanisms like earnouts. That's where part of the payment depends on the business actually hitting specific targets after the sale.
So linking price to actual future results.
Exactly. The seller note handles the financing structure, and earnout can handle performance uncertainty. They can work together to get a deal done when there's a difference in outlook. It aligns risk and reward during that critical post-sale period.
Okay, so taking all this on board, the mechanics, the pros for both sides, the collaborative angle, when does seller financing really make the most sense? What kind of situations did the sources point to?
It seems particularly well suited and very common in sales of those small to mid-sized businesses. You know, the ones maybe doing, say, $1 million to $50 million in revenue. That seems to be a sweet spot.
And what is it about that specific market segment?
A few things come together there. Buyers often find it harder to get 100% bank financing. Maybe the business doesn't have loads of hard assets banks like. And sellers in that space, often they're founders, maybe they're really invested in the company's legacy, their employees' futures.
So it's not just financial, it could be personal too.
It often is. They might prioritize finding the right buyer, someone they trust to carry things on. Offering some financing can help secure that right buyer and maybe get a slightly better overall package. It's also great when banks are just hesitant. Maybe it's a niche industry they don't get or the business model is unusual.
And fundamentally, it loops back to filling that funding shortfall.
Yeah, that's its core power, absolutely. It completes the picture when the buyer's cash and the bank loan don't quite cover the whole price. And because it's a direct deal between the two main parties, it can sometimes cut down on the complexity and time involved dealing with multiple outside institutions.
Okay, so let's bring this home for everyone listening. What's the main thing you should take away from this deep dive?
I think the core message is that seller financing is this really practical, really flexible tool that genuinely helps business sales get across the finish line. It's especially important for all those small and mid-sized companies that, really are the engine of the economy.
And the relevance for you, the listener. Well, if you're even thinking about buying a business, you absolutely need to understand seller financing. It could unlock opportunities you thought were out of reach, and it gives you enormous flexibility to structure a deal that actually works for you financially.
Definitely. And if you're on the other side, thinking about selling your business, exploring seller financing isn't just a maybe. It can seriously expand your buyer pool, potentially help you negotiate a better overall value through favorable terms, offer potential tax advantages over time, and maybe just as important, lead to a smoother handover with a buyer who's truly aligned with you for success. It's a key strategic lever for both sides.
That's been a really clarifying look at how this financing structure works and why it matters.
It really does change the whole dynamic of a transaction in some pretty fundamental ways.
So here's something to chew on after we wrap up. Really think about how a seller keeping a financial stake in the business after the sale might actually change the kind of support and advice they give during that transition. What does that shared interest look like in practice, day to day, compared to a deal where the seller just takes their check and is gone?